Hi guys, my name is Genevieve Garcia. So now I will discuss to you who issues bonds. So before we go to our topic, which is who issues bonds, let us first know the meaning of bond. So bond is a long-term debt instrument. It is a long-term contract under which a borrower agrees to make payments of interest and principal on specific dates to the holders of the bond. Bonds are issued by corporations and government agencies that are looking for a long-term debt capital. So it is a fixed income instrument, may be in the form of bills, notes, bonds, commercial papers, or promissory notes. So basically, if we're going to analyze the meaning of the bond, it is simply a loan given to a company or government by an investor. So by issuing a bond, a company or government borrows money from investors who in return are paid interest on the money they have loaned. So companies and governments issues bonds frequently to fund new projects on ongoing expenses. So some investors use bonds in hopes of preserving the money they have while also generating additional income. So bonds are often viewed as a less risky alternative to stocks and are sometimes used to diversify a portfolio. So now let's go to our topic, who issues bonds. So first there is the treasury bonds. So when we say treasury bonds, it is issued by the federal government, sometimes referred to as a government funds. So the federal government might use this money to make a social security payments or fund the construction of infrastructures like roads. So it is reasonable to assume that the government will make good on its promised payments, so treasuries have no default risk. So basically, when we say treasury bonds, it is bonds that came from or that comes from our government. So the treasury bonds is popular investment because of their safety. However, not all government bonds are the same. So the treasury performs a number of duties, but in a nutshell. So the treasury's job is to raise money for government expenses and pay the nation's bills. So the treasury bonds or the treasury itself typically raises money in one of two ways. So number one is through taxes, and the number two by issuing bonds to the investors. So now in this slide, we can see the picture of the Republic of the Philippines Bureau of the Treasury. So this government agency is the one who is responsible to raise money for the government through bonds. So the treasury bonds are long-term, low-risk instruments that are direct and unconditional obligations by the government of the Philippines. So its features is the interest payment is semi-annual, computed based on the coupon rate. So the interest income of the investment is subject to 20% final withholding tax. So in this slide, we can see the retail treasury bonds form part of the national government's program to make government securities available to retail investors, especially individuals. So we can see here the key features and the objective. So now on the other side, we can see the terms of offering, which is it's written the issuer, the issue, the tenor, the gross rate, the interest payments, use of proceeds, the offer period, and the issue date. So now let's go to the second one, which is the corporate bonds. So when we say corporate bonds, it is issued by the business firms. So it is unlike the treasuries, corporate bonds are exposed to default risk. If the issuing company gets into trouble, it may be unable to make the promised interest and principal payments, and bondholders may suffer losses. So the corporate bonds have different levels of default risk depending on the issuing company's characteristics and the term of the specific bond. So the default risk is often referred to as credit risk. The higher or the larger this risk, the higher the interest rate investors demand. So basically, when we say corporate bonds, it is from a private businesses or the businesses firms. It may be the small or the big ones. So it has a default risk because there is a risk for the investors. So the higher the risk of that bond is also the higher the demand of the interest of the investor wants from the specific company or a corporate. So now in this slide, we can see the simple example of the corporate bonds. So corporations may tap into bonds for some reasons to fund projects. So for example, a tech company might use the money to finance a new factory that will produce the next hot gadget. So these new projects could have a positive impact on the economy as a whole. So the factory or the new factory creates new jobs, and then the factory workers would then have a paycheck that they could spend or invest. So either way, they're helping to fuel the economy. The third one, which is the municipal bonds. So it is also called as munis, which is the term given to bonds issued by state and local governments. So like corporates, munis are exposed to some default risk, but they have one major advantage over all other bonds. So the interest earned on the most munis is exempt from federal taxes and from state taxes if the holder is the resident of the issuing state. So consequently, the market interest rate on a muni is considerably lower than on a corporate bond or equivalent risk. So it means that the municipal bonds has a lower risk than all other kinds of bonds because its interest is mostly coming from the federal taxes or the government taxes itself. So a municipal bond's maturity date, which is the date when the issuer of the bond repays the principal, may be years in the future. So the short-term bonds mature in 1 to 3 years, while the long-term bonds won't mature for more than a decade. So it means that the usual municipal bond is not less than 3 years and also not more than a decade. So here we have the simple example of municipal bond. So one city wants to build a new hospital, so it decides to issue bonds to raise money. Each bond is loaned for 5 million, which the city promises to pay back in 10 years. So it means it is a long-term debt or a long-term bond. So to make this loan more attractive to investors, the city agrees to pay an annual interest rate of 5%, which in the bond world is also known as a coupon rate. So now let's go to our fourth one, which is the foreign bonds. So when we say foreign bonds, it is bonds issued by a foreign company or a foreign corporation. All foreign corporate bonds are exposed to default risk, as are some foreign government bonds. So a foreign bond is issued by an international company in a country different from their own and using that country's currency to denominate those bonds. So domestic investors can diversify internationally by owning foreign bonds, and since they are traded on local exchanges, are easier to acquire. So simply, the foreign bonds is a bond came from other countries. So for example, the Philippines are selling its bonds to other country. The currency that will be used is the other country's currency rate, not the currency rate in the Philippines. Still, foreign bonds have certain implicit and explicit risks associated with them, including the impact of two interest rates, currency exchange rates, and geopolitical factors. An additional risk exists when the bonds are denominated in a currency other than of the investor's home currency. So here is a simple example of a foreign bond. So bond denominated in the US dollars issued by a German company in the United States. So we can see here that the German company is the one who offered or who sold its bond to the United States. So the currency rate that has been used is the currency rate of the United States. So here are the other examples of foreign bonds, which is the Yankee bonds traded in the United States, Bulldog bonds traded in the United Kingdom, Samurai bond traded in Japan, and the Matador bond traded in Spain. So this Yankee, the Bulldog, the Samurai, the Matador is only name given to the bonds on a different country. So for example, in Japan, their bonds, when it comes to foreign or when they're selling their bonds, it is called as a samurai bond.
Good evening, everyone. I am Miss Christina Kate L. Galimlim, and I am the second reporter for today's topic. My part of the report is the key characteristics of bonds. Although all bonds have some common characteristics, different types of bonds can have different contractual features. Example, most corporate bonds have provisions that allows the issuer to pay them off early, called features. But the specific code provision vary widely among the different bonds. Similarly, some bonds are backed by specific assets that must be turned over to the bondholders. If the issuer defaults, well, the other bonds have no such collateral backup. Differences in contractual provisions and in the fundamental underlying financial strength of the companies backing the bonds leads to different in bonds risk, prices, and expected returns. To understand bonds, it is essential that you understand the following terms. The first term is the par value. The par value is the stated face value of the bond. The par value generally represents the amount of money the firm borrows and promises to repay on the maturity date. Par value is also known as nominal value. Par value is important for a bond or fixed income instrument because it determines its maturity value as well as the value of the coupon payments. The second term is the coupon interest rate. Allied food products bonds requires the companies to pay a fixed number of dollars of interest each year. This payment, generally refers to as the coupon payment, is set at the time the bonds is issued and remain in force during the bond's life. When this annual coupon payment is divided by the par value, the result is the coupon interest rate. The interest rate paid on a bond by the issuer for the term of the security. The term coupon is derived from the historical use of actual coupons for periodic interest rate collections. The third term is the maturity date. Bonds generally have a specified maturity date on which the par value must be repaid. Allied bonds, which were issued on January 4, 2016, will mature on January 3, 2031. Thus, they had a 15 years maturity at the time they were issued. Most bonds have an original maturity ranging from 10 to 40 years, but any maturity is legally permissible. Maturity date is the date on which the final payment is due on a loan or other financial instruments such as bonds or term deposit, at which point the principal is due to be paid. Other features. Several other types of bonds are used sufficiently often to warrant mention. Convertible bonds are bonds that are exchangeable into shares of common stocks at a fixed price at the option of the bondholder. When we say convertible bonds, these are debt instruments that can be converted into equity share of the company at a future date. Callable bonds give the issuer the right to retire the debt prior to maturity. Putable bonds allow investor to require the company to pay in advance. Callable bonds give the issuer an opportunity to refinance its debt at an alternative rate. Income bonds, which pays interest only if the issuer has earned enough money to pay the interest. Income bond is a type of bond that pays interest at a rate based on the issuer's earning.
Good day everyone, I am Rhea Hintalan and I will be discussing about the bond valuation and assessing a bond riskiness. But first, let me discuss what is bond valuation. Bond valuation is the value of any financial asset, a stock, a bond, or a list, or even a physical asset such as an apartment building or a piece of machinery is the present value of the cash flow by asset is expected to produce. In the case of a floating rate bond, the interest payment vary over time. For zero coupon bond, there are no interest payment, so the only cash flow is the face amount when the bond matures. So, the bound valuation is a technique for determining the theoretical fair value of particular bond. Bound valuation includes calculating the present value of a bond's future interest payments, also known as its cash flow, and the bond value upon maturity, also known as its face value or par value. For a regular bond with a fixed coupon like ALID, wherein RD is equal to 10%, the market rate of interest in the bond. This is the discount rate used to calculate the present value of the cash flow, which is also known as the bond price. And M is equal to 15. It is the number of years before the bond matures. And INT is equal to dollars of interest paid each year. So to get the INT, coupon rate times par value, which is 0.10 times 1,000 is equal to 100. And also, in calculator terminology, INT times PMT is equal to 100. And M is equal to 1,000. It is the par or maturity value of the bond. This amount must be paid at maturity. We can now redraw the timeline to show the numerical values for all variables except the bond's value and price, assuming an equilibrium exists. So the following general equation can be solved to find the value of any bound. So VB is equal to INT divided by 1 plus RD raised to 1 plus INT divided by 1 plus RD raised to 2 and so on and so forth, plus INT divided by 1 plus RD raised to n plus M divided by 1 plus RT raised to n. So the n is the number of years before the bond matures. So n is the summation of t is equals to 1. So INT divided by 1 plus RD raised to t plus M divided by 1 plus RD raised to n. Inserting values for the ALID bound, we have VB is equals to 15 summation of t is equals to 1. So 100, which is the INT divided by 1.10. So 1.10 because 1 plus RD, which is the discount rate, is equals to 1.10 raised to t plus 1,000 divided by 1.10 raised to 15. So 1,000 is the par or maturity value of the bound divided by 1.10 raised to 15, which is the number of years before the bond matures. So, as you can see in the previous slide, using a financial calculator to solve the problem, the calculator is programmed to solve the equation. Input n is equals to 15 and RD is equals to I or year, which is 10, and INT is equals to PMT, which is 100, and M is equals to FB, which is 1,000. Then press the PV key to find the bounds value, which is 1,000.5 because the PV is an outflow to the investor. It is shown with a negative sign because the calculator is programmed to solve the equation and it finds the PV on an annuity of 100 per year for 15 years discounted at 10%. Then it finds the present value of the 1,000 maturity value. Then it adds those two present values to find the bounds value. With increase in the market interest rate, RD causes the price of the outstanding bond to fall, wherein a decrease in the rate causes the bond price to rise. For example, if the market interest rate on ALID bond increased to 15% immediately after it was issued, we would recalculate the price with the new market interest rate. So, the PV is equals to N is equals to 15. It is the number of year before bond matures, and I or year is equals to discount rate or RT, which is 15%, and INT is equals to PMT, and maturity value of the bond is equals to FB, which is 1,000. Then press PV, it is equals to negative 707.63. Also, the present value of this bond can be calculated using Excel PV function. So, PV rate is equals to 0.1 and PER is equals to 15, PMT is equals to 100, and FB is equals to 1,000. And before clicking the enter, put space or blank after the 1,000. and the bond price would fall to 707.63, well below par as a result of the increase in interest rate. There are two types of bond, the discount bound and premium bound. Discount bound is a bond that sells below its par value, occurs whenever the going rate of interest is above the coupon rate. And premium bound is a bond that sells above its par value, occurs whenever the going rate of interest is below the coupon rate. For example situation, RD is equals to coupon rate, fixed rate bound sells at par, hence it is a par bound. So RD is greater than coupon rate, fixed rate bound sells below par, hence it is a discount bound. So RD is less than coupon rate, fixed rate bound sells above par, hence it is a premium bound.
Hello, my name is Daniel Marigliani and my topic to be discussed is bond yields. So bond yield is the rate of return an investors realize on a bond. So what happens is that when an investor buys bond, they essentially lend money to the bond issuer, and in return, the bond issuers agree to pay interest to the investors throughout the life of the bond and to repay the face value of the bond upon its maturity. So if you ever see a bond market table on the Wall Street Journal or a price sheet, you will typically see information regarding each bond's maturity date, price, coupon interest rate, and a report yield. Unlike coupon interest rate, which is fixed, bond yield varies from day to day depending on the current market condition. To be most useful, bond yield should give us an estimate of the rate of return we would earn if we purchase the bond today and hold it over its remaining life. If a bond is not callable, its remaining life is its year to maturity. If it's callable, the remaining life is the year to maturity if it's not called, or the year to the call if it's called. In the following section, we explain how to calculate those two possible yields and which one is likely to be earned by an investor. What we are saying here is that there are two possible outcomes if you happen to purchase a bond. First is that your bond will be held up to its remaining period or its maturity. Second, if it's callable, it can be called, or in simple words, be taken out from you or bought back from you. Yield to maturity. Yield to maturity is the calculation we use to calculate the rate of return earned if the bond is held to maturity. Receive the promised interest payment and maturity value. It is also the interest rate generally discussed by investors when they talk about rates of return. Calculating yield to maturity is a bit complicated when done manually. That is because calculating yield to maturity is a tedious, time-consuming trial and error process. What we need to do is find a specific yield to maturity value and match it with the price. But there is an easy way for us to calculate yield to maturity, and that is by using a financial calculator. For this example, you have just purchased an outstanding 15-year bond with a par value of $1,000 for $1,145.68. Its annual coupon payment is $75. What is the bond year to maturity? So here we can simply use a financial calculator and input the following data. N is equals to 15, par value is equals to negative 1,145.68, periodic payment is equals to 75, and future value is equals to 1,000. The answer will automatically come out, and in this case, it is 6%. You can also find the yield to maturity with a spreadsheet in Excel. Use the rate function. So, just input the data rate 15, 75, negative 1,145.68, and 1,000. The result will come out to be similar to the financial calculator, which is 6%. Yield to call. Yield to call is the financial term that refers to the return a bondholder receives if a bond is held until the call date, which occurs sometimes before it reaches maturity. Yield to call applies to all callable bonds, which are debt instruments that let bond investors redeem the bond or the bond issuer to repurchase the bond on what is known as the call. The ideal scenario for a bond issuer to call a bond is when the bond's price is above its par value. This typically means that the current market interest rate is less than the coupon interest rate. By doing so, the bond issuer can actually save money by calling the bond and creating a new bond at the current market interest rate. For this example, you have just purchased an outstanding 15-year bond with a par value of $1,000 for $1,145.68. Its annual coupon payment is $75. Now, assuming that this bond is callable in 7 years at a price of $1,075, what is its bond's yield to call? Using a financial calculator, we can simply input the following data. N is equals to 7. N now will be the remaining period at which the bond is callable. Par value of negative $1,145.68, periodic payment of 75, future value of 1,075. This will give us the answer of 5.81%. You can also use the rate function in the Excel by simply typing the following data, and that will also give you the same result of 5.81%. Now, we talk about changes in bond value over time. Newly issued bonds generally sell at prices very close to par, and because coupon payments are constant, when economic condition changes, a bond with a $100 coupon that sold for $1,000 par value when it was issued will sell for more or less than $1,000 thereafter. What we are saying here is that the bond's value may change over time because of the volatility of the bond market that is subjected to economic conditions. This is why we use the calculation of yield to maturity and yield to call to measure the rate of return when such changes happen over time. So here are some examples of the changes in a bond's value over time. So for this example, there are 3 equally risky issues that will mature in 15 years. First is a 15-year bond that has a 10% annual coupon. They were issued at par, which means that the market interest rate on their issue date was also 10%. Because of the coupon rate equals the market interest rate, these bonds are trading at par or $1,000. Second was 5 years ago. Allied issues a 20-year bond with a 7% annual coupon. This bond currently have 15 years remaining until maturity. They were originally issued at par, which means that 5 years ago, the market interest rate was 7%. Currently, this bond's coupon is less than the 10% market rate, so they sell at a discount. Using a financial calculator or a spreadsheet, we can quickly find that they have a price of $771.82. Third was 10 years ago. Allied issues a 20-year bond with a 13% annual coupon. This bond currently has a 15 years remaining until maturity. They were originally issued at par, which means that 10 years ago, the market interest rate must have been 13%. Because their coupon rate is greater than the current market rate, they sell at a premium. If we use a financial calculator or a spreadsheet, we can calculate the price, which is $1,228.18. So for these examples, each of these 3 bonds has a 15-year maturity. Each has the same credit risk, and thus, each has the same market interest rate, 10%. However, the bond have different prices because of their different coupon rates. Table 7.1, it shows that the prices of each of these bonds will change over time if the market interest rate remains at 10%. It also shows the current yield, the capital gain yield, and the total return over time. The table shows that if the bond was selling at a discount, its price will increase over time. Then the capital gain would be positive, plus its current yield will increase. If the bond was selling at par, and the market interest rate remains the same, its current yield will remain the same, and its capital gain will always be at 0. If the bond was selling at a premium, its price would decline over time. Its capital gain yield would be negative, but it would be offset by a high current yield. Figure 7.2 plots the 3 bonds predicted price as calculated in Table 7.1. Notice that the bonds have very different price path over time, but at maturity, all three will sell at par value of $1,000. Although the price of the 7% and 13% coupon bonds move in opposite direction over time, each bond provides investors with the same total return, 10%, which is also the total return in the 10% coupon par value bond. The discount bond has a low coupon rate and therefore a low current yield, but it provides a capital gain each year. In contrast, the premium bond has a high current yield, but it has an expected capital loss each year.
Another part of my report is about bonds with semi-annual coupons. Semi-annual bonds basis is a conversion methodology that allows investors to directly compare yields on bonds with varying characteristics. Since bonds come with all sorts of interest rates and payment frequencies, it is essential to be able to find some standard measure to compare different kinds of bonds side by side. Although some bonds pay interest annually, the vast majority actually make payments semi-annually. To evaluate semi-annual bonds, we must modify the valuation method as follows. 1 is divide the annual coupon interest payment by 2 to determine the interest paid each 6 months. Since semi-annual is about paying coupon rate every 6 months, we will divide the payment with 2 to determine the interest paid each 6 months. So the second is multiply the year to maturity and by 2 to determine the number of semi-annual coupons or semi-annual period. The number 3 is divide the nominal quote interest rate RD by 2 to determine the periodic semi-annual interest rate. On a timeline, there would be as many payments, but each would be half as large as with annual payment bond, making the indicate changes results in the following equation for finding a semi-annual bond's value. The equation is the summation of INT divided by 2 over 1 plus R sub D divided by 2 raised to T plus M over 1 plus R sub D divided by 2 raised to 2n as T goes 1 to 2n. To illustrate, assume that Allied Foods 15-year bonds as discussed in Section 7 pay $50 of interest each 6 months rather than $100 at the end of each year. Thus, interest payment is only half as large but there are twice as many of them. We would describe the coupon rate as 10% with semi-annual payments. When the going nominal rate is RD 5% with semi-annual compounding, the value of 15-year, 10% semi-annual coupon bond that pay $50 interest every 6 months is found as follows. So here, N is the number of how many times Allied Foods will pay interest. I or YR is the interest rate, PMT is the interest every 6 months, and FV is the face value of the bond. Using a financial calculator or Excel, N is equals to 30, RD/YR is 2.5, PMT is equals to 50, FV is equals to 1,000. Press the PB key to obtain the bond's value, which is 1,523.26. So, the value with semi-annual interest payment is slightly larger than 1,518.96, the value when interest is paid annually as we calculated in Section 7. So, this higher value occurs because each interest payment is received somewhat faster under semi-annual compounding. Alternatively, when we know the price of a semi-annual bond, we can easily back out the bond's nominal yield to maturity. In the previous example, if you were told that a 15-year bond with a 10% semi-annual coupon was selling for $1,523.26, you could solve the bond's periodic interest rate as follows. To solve the bond's periodic interest rate, we need to use a financial calculator or Excel, in which n is equals to 30, PV is equals to 1,523.26, PMT is equals to 50, FV is equals to 1,000. Press the I/YR key to obtain the interest rate per semi-annual period, which is 2.5%. Multiplying by 2, we calculated the bond's nominal yields to maturity to be 5%. Upon internalizing and searching for my topic, I found an easy and simpler way to calculate bonds with semi-annual coupons. So here is the example. Determine the amount of semi-annual coupon paid for a 2.75% bond with a face value of $75,000 which matured after 10 years. So the given is the face value which is $75,000 and the coupon rate which is 2.75%. So to calculate semi-annual coupon amount, we will use the formula F times R divide 2. So we will substitute the amount. F is equals to 75,000 and R will be converted to decimal value which is 0.0275 divided by 2. So after calculating, we will have the result of 1,031.25, which is the semi-annual coupon amount. So here is another example. Determine the amount of semi-annual coupon paid for a 4% bond with a face value of 200,000, which matures after 10 years. How much and how many coupons are paid? So we have the given, which is the face value of 200,000, coupon rate of 4%, T is equals to 10, and M is equals to 2. To calculate semi-annual coupon amount, we will use the same formula that we used previously. So F times R over 2, which is F is equivalent to 2,000 and R is 0.04 divided 2. After calculating, we will get the result of 4,000. So to calculate how many coupons are paid, we will use the formula M times T, which is M is equals to 2 and T is equals to 10. And multiplying it, we will get a 20, in which we have 20 payments paid to pay the bonds.
A price risk. Price risk, also called interest risk, is the risk of a decline in the bond values due to an increase in interest rates. Price risk is higher on bonds that have long maturities than on the bonds that will mature in the near future. The longer the maturity, the longer before the bond will be paid off, and the bondholder can replace it with another bond with a higher coupon. So here's an example on how the value of a 1-year bond with a 10% annual coupon fluctuates with changes in RD, and then comparing those changes with the changes of a 15-year bond. The 1-year bond values of a different interest rate are shown below. So as you can see in the previous slide, the example shows that the interest rate increase would cause the bond price to fall from 1,000 to 707.63. So you would have a loss of 292.37 on the bond. And because of interest rate can do rise, rising rate cost losses to bondholders, and people or firm who invest in the bonds are exposed to risk from increasing interest rates. Reinvestment risk. Reinvestment risk is the risk that a decline in interest rate will lead to a decline in income from a bond portfolio. A decrease in interest rate can also hurt bondholders because if the interest rate falls, long-term investment will suffer a reduction in income. So, comparing price risk and reinvestment risk. Price risk relate to the current market value of the bond portfolio, while reinvestment risk relate to the income the portfolio produced bonds maturity and coupon rate affect its price risk and reinvestment risk. The longer maturity bond is high in level of price risk, while it is low in level of investment risk, while higher coupon bond is low in level of price risk and it is high in level of reinvestment risk. A long-term zero coupon bond will have a very high level of price risk and relatively little reinvestment risk. In contrast, a short-term bond with a high coupon rate will have a low price risk but considerable reinvestment risk. Investment horizon is the period of time an investor plans to hold a particular investment, while duration is the weighted average of the time it takes to receive each of the bond cash flow. And the long-term bond will face significant price risk because the value of the portfolio will decline if interest rate rise, but will not face much investment risk because income will be stable. While short-term bond will not be exposed to much price risk, but will be exposed to significant investment risk.
Let's talk about that risk for a minute. As previously stated, that risk could be derived from more than one source. One of them, and the most common and widely discussed, is what I'm going to discuss for today. It's what we call the default risk. Now, the default risk is the likelihood that something does not happen, that the issuer says, I'm no longer going to pay. Maybe because he or she can't, maybe for a reason that ayaw niya lang talaga, or maybe for a reason that his or her financial capacity are so low. It's kind of irrelevant for my discussion today, but the problem is that those cash flows are unlikely to be paid. The bottom line here is the default risk is one of the key ways, ulitin ko po, one of the key ways in which we evaluate the risk of bonds, but it's certainly not the only one. Going back to where we were, potential default is another important risk that bondholder face. If the issuer defaults, investor will receive less than the promised return. The probability that you will not pay the coupons that you have promised is known as default risk, and there are companies that can tell you whether or not this is likely to happen. That is precisely what rating agencies do now. They basically go into government, company, or any issuer and analyze and assess the likelihood that you will pay back or not. They look at your history and financial. Hinahalungkat nila yon just to determine whether you have the ability to pay and willingness to pay. And pagkatapos, they will give you a rating that I will show you in a minute. There are various types of corporate bonds, but what is a corporate bond? Corporate bonds are issued by corporation and are exposed to default risk. Different corporate bonds have different levels of default risk, depending on the issuing company's characteristics and on the terms of the specific bond. It can be backed by a variety of assets such as mortgages, equipment, or other companies. Default risk is influenced by financial strength of the issuer and the terms of bond contract, including whether collateral has been pledged to secure the bond. The characteristics of some key types of bond are to be followed. For the first type of the corporate bond, the mortgages bond. Under a mortgage bond, the corporation pledges specific assets as security for the bond. A bond backed by fixed asset. Fixed mortgage bonds are senior in priority to claims of second mortgage bond, while second mortgages are called junior mortgages because they are junior in priority to the claims of senior mortgages or the first mortgage bond. To further discuss a mortgage bond, let me add another info. A mortgage bond is a bond in which holders have a claim on the real estate assets put up as its collateral. A lender might sell a collection of mortgage bond to an investor who then collects the interest payments on each mortgage until it's paid off. If the mortgage owner defaults, the bondholder gets the house. And if the owner defaults on the mortgage bondholders have a legal claim on the property. Ibig sabihin lamang po that the mortgage bond gives the bondholder the ability to sell mortgage properties to satisfy any unpaid obligation to bondholders. So ang katanungan dito, how does a mortgage bond work? Banks and mortgage lenders can package these mortgages into bond securities and then sell them to other investors, allowing them to raise more capital quickly without waiting for the full loan term to pass. However, the interest on a mortgage bond can fluctuate. Ibig sabihin po, it doesn't have a fixed rate of return and doesn't come with a principal payment at the end of the term. All mortgage bonds are subject to inditure, a formal contract, which is a legal document that spells out in detail the rights of bondholders as well as the corporation. It sets forth the details of all the terms and conditions of the bonds, tulad na lamang po ng exact day of their maturity, the timing of the interest payments and how they are calculated, as well as the details of any special features. To further discuss what is a bond indicature, tulad ng nasabi ko kanina, it is a formal contract and agreement. So the question is, paano ito gumagana o paano ito ginagamit? It varies from issue to issue, and it's a very technical document which prescribe every detail of the bond's provision, tulad na lamang po ng day-to-day management of the bond. For the second type of the corporate bond, which is the debentures, it is a long-term bond that is not secured by a mortgage on a specific property tulad na lamang po ng designated properties and other assets. And as such, it provides no specific collateral as security for the obligation. Ibig sabihin po, debenture holders are general creditors whose claims are protected by property not otherwise pledged. To make it simple, debentures are unsecured bonds that are not backed by and usually issued by corporations with strong credit ratings and therefore do not typically offer high interest rates. For the third and last type of the corporate bonds, which is the subordinated debentures, bonds having a claim on assets only after the senior debt have been paid in full in the event of the liquidation. It is an unsecured bond that ranks below other, more senior loans or securities with respect to the claims on assets or earnings. Borrowers of subordinated debentures are usually larger corporations and other business entities. To make it simple, subordinated debentures are any type of loans that paid after all other corporate debts and loans are repaid. In the case of the borrower default, meaning creditors who own subordinated debentures will not be paid out until all senior bondholders are paid in full. The three largest agencies are Standard and Poor's, Moody's, and Fitch, and these three are far the biggest one. Probably during 2008-2009 crisis, these names are quite well known because this whole story that there were bonds that were highly rated at Indian defaulted, which is not what typically happens, but it does happen and it did happen during the global financial crisis. Going back to what I've mentioned earlier, default risk is the probability that you will not pay the coupons that you have promised. And these three largest agencies will give you a judgment whether that is going to happen or not. Now, there's many and let me jump into that. This is actually a table taken directly from the case that I've mentioned earlier, and we're not going to get into all the information. What matters for us is that those letters are what we call a credit ratings or simply a ratings. They go triple A, double A, and A, and as you see there, triple B, and so forth. It's one of those in which the issuer couldn't or didn't want to pay, and therefore the bond stopped there. But that doesn't mean that that's the end of the story. Typically, when an issuer doesn't pay, they sit together with the owners of the bond and try to negotiate something. Meaning po, dumadaan sila sa proseso, pinag-uusapan muna nila bago magkaroon ng isang hakbangin. But at least, as far as we are concerned, the bond is in default. Bond rating criteria. The three largest agency rating is shown above. The triple and double A bonds are extremely safe. Single A and triple B bonds are strong enough to be called investment grade bonds, and they are the lowest rated bonds that many banks and other institutional investors are permitted by law to hold. Double B and lower bonds are speculative or junk bonds, and they have a significant probability of going into default. The framework used by rating agencies examines both quantitative and qualitative factors. Quantitative factors relate to financial risk, examining a firm's financial ratios. Historical, they show the firm's condition in the past, whereas bond investors are more interested in the firm's condition in the future, while qualitative factors considered include an analysis of a firm's business risk, tulad na lamang po ng kanyang pagiging competitiveness within its industry and the quality of its management. There are three determinants of bond ratings. Yung una po is yung financial ratios. All of the ratios are potentially important, but those related to financial risk are key. The rating agency's analysts perform a financial analysis along the lines discussed in Chapter 4 and forecast future ratios along the lines described in Chapter 16. For the second determinant, which is the qualitative factors, bond contract terms. Every bond is covered by a contract na tinatawag po na indenture. It is a formal agreement or contract between the issuer and the bondholders. The indenture spells out all the terms related to the bond. Included are the maturity, the coupon interest rate, a statement of whether the bond is secured by a mortgage on specific assets, or any sinking fund provisions, and a statement whether the bond is guaranteed by some other party with a high credit rating ranking. Other provisions might include restrictive covenants tulad po ng requirements that the firms not let its debt ratio exceed a stated level and that it keeps its time interest term ratio at or above a given level. Some bond indentures are hundreds of pages long, while others are quite short and cover just the terms of the loan. For the third and last type of the determinants of the bond rating, which is the miscellaneous qualitative factor. Included here are issues like the sensitivity of the firm's earning to the strength of the economy, the way it is affected by inflation, a statement of whether it is having or likely to have labor problems, the extent of its international operation, including the stability of the countries in which it operates, potential environmental problems, and potential antitrust problems. Today, the most important factor is exposure to the subprime loans, including the difficulty to determine the extent of this exposure as a result of the complexity of the assets backed by such loan. We see that bond ratings are determined by great many factors tulad na lamang po ng quantitative and qualitative or subjective factors. Also, the rating process is dynamic at times. One factor is of primary importance, at other times some other factors is a key. Bond ratings are important to both firms and investors. It is an important process because the ratings alert investors to the quality and stability of the bond. That is, the rating greatly influences interest rates, investment appetite, and the bond pricing. The first importance of bond ratings, it is an indicator of its default risk. The rating has a direct measurable influence on the bond's interest rate and the firm's cost of debt. As the given table above, it provides a summary of the criteria of a rating agency examines when rating a company's bond. Panel A show how business and financial risk determine the anchor for establishing the underlying bond rating. Now let me jump into that. They go triple A, double A, and single A, and as you see there, triple B and so forth. The triple A, double A, and single A, and the triple B, those have a very low probability of default, but that doesn't mean that it will never default, but it means that it have a fairly low probability of default to the point that some investors by law can only buy investment grade bonds. Now, most of these letters, with the exception of triple A, have pluses and minuses. So you have the double A, the single A, the triple B. Those you can handle double A plus and double A and A minus. You can have A plus, A and A minus, and on and on and on. The only one that doesn't have A plus is the triple A. But the bottom line is that this is the way we evaluate whether companies or issuer in general are likely to pay or not. The bottom line is, if we think about, well, so how do we come up with these ratings? Hindi na natin kailangan isipin yon because that's what credit agency do, and for that they look at different variables and we can never guess exactly kung ano yung gagawin nila. But we know some of the variables that are very important. One of them is obvious, which is the debt ratio. How much debt you have relative to the total capital that you have in the company. Kung isipin natin, now everything else is equal to the higher debt ratio. The higher the proportion of the debt that you have relative to the total capital, the more that you are going to have to pay because the riskier you become. And if you have a very little debt, then it's very likely that you're going to pay back all of the coupons and principal. But if you are highly indebted because you are in trouble, then that decreases substantially the probability that you are going to pay. You're going to get a bad credit rating and then your return that you have to offers is going to go up. The other one is the interest coverage. It's important for another obvious reason, which is this is basically how much profits you have to pay interest on the bond. The more profits you have per dollar of interest that you have to pay, then the safer you are. The less profits that you have relative to the interest that you have to pay, then the more dangerous and riskier you are. And therefore, the worse is going to be your rating. Now, we could go on, and we know that there are more variables that matter. But at the end of the day, the debt ratio and the interest coverage are two of the main variables that rating agency look in order to determine how much you have to pay and in order to give you the ratings for the company. Now, going back to the four bonds that we have in the case, notice one interesting thing. Remember that triple B plus is the worse than triple A, and double C is a lot worse than triple B and triple A. Now, triple A and triple B plus, those are investment grade. Double C is a non-investment grade or junk or high yield. However, kung ano man yung gusto mong tawagin doon. The second importance of the bond rating, most bonds purchased by institutional investors rather than individuals, and many institutions are restricted to investment-grade securities. Thus, if a firm's bonds fall below triple B, it will have a difficult time selling new bonds because many potential purchasers will not allow to buy them. For the given structure above, this is the panel B. It illustrates how this anchor is combined with a comprehensive set of other factors to determine the issuer's final credit rate. A result of their higher risks and more restricted markets, lower grade bonds have higher required rates of return kaysa sa high grade bonds. In each of the years shown on the graph, US government bonds have had the lowest yields, while triple A bonds have been next and triple B bonds have had the highest yields. The figure also shows that the gaps between yields on the three types of bonds vary over time, which indicate that the cost differentials or yield spread fluctuates from year to year. Most recently, there was a dramatic increase in the yield spread between corporate and the treasury securities in the aftermath of the recent financial crisis. In the years since the crisis, these spreads have narrowed as investors have slowly become once again more willing to hold riskier securities. This point is highlighted in 7.5, which gives the yields on the three types of bonds and the yield spreads for triple A and triple B bonds over treasuries in January 2009 and January 2015. The risk-free rate or the vertical axis intercept was lower in January 2015 than it was in January 2019. Second, the slope of the line has decreased. In the crisis period of 2009, investors were both pessimistic and risk-averse, so spreads were quite high. As noted above, these spreads have subsequently fallen as economic conditions have slowly improved. Changes in firms' bond rating affects its ability to borrow funds and its cost of that capital. Rating agencies review outstanding bonds on a periodic basis, occasionally upgrading or downgrading a bond as a result of its issuer change circumstances. For example, on March 20, 2015, S&P raised the corporate credit rating of Apartment Investment and Management Corp. or the AIMCO, one of the largest owners and operators of apartment communities in the US. From BB plus to BBB minus, S&P's decision to upgrade the firm's credit rating was due to its well-diversified apartment portfolio, both in terms of geography, the price, the expectation of modest rent increases and a modest decline in its debt levels. At the same time, S&P lowered the corporate credit rating of Sprint Corp, a telecommunication and wireless network company, from BB- to B+. S&P's decision to downgrade the company's credit rating reflected expectation of aggressive price competition in the industry, network performance issues, and the company's high cost structure. Over the long run, rating agencies have done a reasonably good job of measuring the average credit risk of bonds and of changing ratings whenever there is a significant change in the credit quality. However, it is important to understand that ratings do not adjust immediately to changes in credit quality, and in some cases, there can be a considerable lag between a change in credit quality and change in rating. For example po, yung sa Enron bonds, still carried an investment grade rating on Friday in December 2001, but the company declared bankruptcy 2 days later. On Sunday, more recently, the rating agencies have come under considerable fire for significantly underestimating the risk of many of the securities that were backed by subprime mortgages. Many worry that rating agencies don't have the proper incentives to measure risk because they are paid by the issuing firms. In response to this concern, the Dodd-Frank Act, which was enacted in 2010, directly the SEC or the SEC to put in place stronger oversight of the rating agency. The exact nature of this oversight remains a work in progress. When a business becomes insolvent, it doesn't have enough cash to meet its interest and principal payments. A decision must then be made whether to dissolve the firm through liquidation or to permit it to reorganize and thus continue to operate. These issues are addressed in Chapter 7 and Chapter 11 of the Federal Bankruptcy Statutes, and the final decision is made by a federal bankruptcy court judge. The decision to force a firm to liquidate versus permitting it to reorganize depends on whether the value of the reorganized business is likely to be greater than the value of its assets if they were sold off piecemeal. In the reorganization, the firm's creditors negotiate with management on the terms of a potential reorganization. The reorganization plan may call for restructuring the debt, in which case the interest rate may be reduced. The term to maturity, lengthened, or some of the debt may be exchanged for equity. The point of the restructuring is to reduce the financial charges to a level that is supportable by the firm's projected cash flows. Of course, the common stockholders also have to take out haircut. They generally see their position diluted as a result of additional shares being given to the debt holders in exchange for accepting a reduced amount of debt principal and interest. A trustee may be appointed by the court to oversee the reorganization, but the existing management generally is allowed to retain control. Liquidation occurs if the company is deemed to be worth more dead than alive. If the bankruptcy court orders a liquidation, assets are auctioned off, the cash obtained is distributed as specified in Chapter 7 of the Bankruptcy Act. Web Appendix 7C provides an illustration of how a firm's assets are distributed after liquidation. For now, we should know that Number 1. The federal bankruptcy statutes govern reorganization and liquidation. Number 2. Bankruptcy occur frequently. Number 3. A priority of the specified claims must be followed when the assets of a liquidated firm are distributed. Number 4. Bondholders' treatment depends on the terms of the bond. And lastly, stockholders generally receive little in reorganization and nothing in liquidation because the assets are usually worth less than the amount of debt outstanding.
So now I will discuss to you the bond markets. Bond markets. So the bond market is a financial market where participants can issue new debt known as a primary market or buy and sell debt securities known as the secondary market. So this is usually in the form of bonds, but it may include notes, bills, and so for public and private expenditures. So here is given the usual transaction in the bond markets, which is the life insurance companies, the mutual funds, the hedge funds, and the pension funds. So a number of leading business publications and websites routinely report key developments in the treasury, corporate, and municipal bond markets. So now let's talk about the accrued interest and the pricing of coupon bonds. So the accrued interest is the one that represents the amount of interest that has accumulated between coupon payments, and it can be calculated as follows. So the accrued interest is equal to coupon payment multiplied by the number of days since the last coupon payment over the number of days in the coupon period. So here is the example of the accrued interest and the pricing of coupon bonds. So the corporate bond issued on March 21, 2015. So the bond's semi-annual coupon is 8% and the par value is $1,000, and then on September 21, 2015, the bond will pay its first $40 coupon. So if you buy the bond on June 8, 2015, which is 79 days since the bond's last coupon payment on March 21, you will have to pay the seller a $17.56 in accrued interest. So here is the solution. So the accrued interest is equal to $40 times or multiplied by 79 over 180, and that is equal to $17.56. So let's define the clean price and the dirty price and how we can get the dirty price. So the clean price is the actual invoice you pay, while the dirty price is the clean price plus accrued interest. So let us assume that the bond's nominal yield to maturity is the same as it was when the bond was issued 8%, which means that excluding accrued interest, the bond continues to trade at par. So it follows that the clean price quoted price is $1,000 and then the accrued interest is $17.56, and when you add this two, this is equal to $1,017.56, which represents the dirty price.